Members of Congress keep buying and selling stocks, but today we're focusing on some shocking massive sales from 7 big name companies that just won't stop popping up on their trading list. And even with some blatant insider trading concern, a recent ethics committee inquiry found not enough action to take this further. So seriously, if you cannot beat them, then why in fact not join them? These politicians are raking in millions of dollars every year, and even unpopular or controversial stocks are bringing in huge returns. And it's not just Nancy Pelosi. Take Brian Higgins in 2023, for example, profiting very, very big. And even with Trump's promise to ban Congress from trading, that still seems very, very unlikely. So today we're diving into 7 big names these lawmakers are selling and why you should be paying attention. So we're going to break down each one, look at the numbers, find out why politicians can't seem to stop selling and what this could mean for you. Clearly, number 1, PepsiCo, which is down around 19% in the last year. Year to date, also not looking good, down 6%. And in fact, this one has massively underperformed the S&P in the last 10 years. We also notice even though 52-week low sits at $128, it is still sitting towards the lower end, and every single analyst, very rare to see, in agreement with members of Congress. They don't see this as a buy, although their tune is more of a hold on every single account. Now, if you remember, RFK becoming the Health and Human Service Secretary was something that looked to be very negative for companies like PepsiCo, and we can also see there are a lot of things that he is asking for them. Whether or not it'll have an effect on the company, on their numbers, is something that remains to be seen. But if we just look at their most recent quarters, their revenue did increase, so that was good to note, but unfortunately one of the things that they are struggling with is their volumes. Consumers are buying less of their products, so something the company does in fact need to battle with, although we've noticed an activist taking a large position of the company and believes if they listen to his advice, these shares could rise more than 50% from the current value. Question is whether or not management will listen to what he has to say. And also, quite interesting, may have gone under the radar, Celsius, which was a very popular stock at the beginning of this year, is one that PepsiCo have in fact now increased their stake. And getting to the bit we'd like to see on a valuation perspective, forward P comes in at 17.3, which not only well below the 5-year of 24, but one of the lowest in the last 5 years. Typically, straight away, we would look at this and call it an undervaluation signal. Remember though, never look at these in pure isolation. Great to see as well a yield near the 4% point, well above the 5-year of 2.9. So we would say on both accounts, potentially severely undervalued. And given the yield is very high in comparison to the 5-year, great to see dividend safety score 93 very safe, with the most recent increase beginning of the year slightly above inflation at 5%, where we also notice on the blue tunnel, in fact for those that don't know, this represents the intrinsic or fair price, another undervalued signal where in fact over the last year it has been in this channel. Not even once has it entered into reasonable territory. And if we zoom out to the last 5 years, in fact from the beginning of 2024, this is one, whilst the intrinsic price has been increasing, the actual share price has been decreasing. We would call this a potential great opportunity to consider solely on valuation. As always, make sure you're subscribed, notification bell is on. When we see high quality companies trading severely undervalued, we will let you know. Now, growth not looking good at a D+, year on year pretty much flat, expected to grow below inflation in 2025. And if we just look at the sector, not great either, below inflation, but actually higher than PepsiCo. And we also notice their 5-year average sitting higher too. So not the greatest performance, at least in the shorter term, which is also reflected on the earnings per share, 4% in the next 3 to 5 years, below both sector and again their own historical. We will, however, point out that in the next 4 quarters, they're anticipating 3 of them to be growth, with a 75% track record, 3 out of 4 beats. Most recent one, 9-cent beat, trading on next full accounting period, forward P just below 17. And finally, before our valuation, if we look at institutions, what they're doing with their 73% ownership, they sold 12 billion, so quite a lot in the last year, but they bought more than twice that in the same time frame, and they bought in fact nearly 3 times as much in the most recent quarter. In fact, if you wanted to see where they were net sellers, you'd have to go to Q1 2024, highlighting that whilst members of Congress are in fact dumping, whilst Wall Street, Seeking Alpha and Quant give this a hold, institutions are doing the opposite. Now, our intrinsic value gets to $147, which is derived as the average of the 3 models. Typically on the channel, we do deep dives of companies where we run through each one, discussing it. We'll also flag here that if you wanted to incorporate Graham's valuation, we have updated all of the figures. Intrinsically, it does come quite low to $84. And the other thing, for those that specifically want to look at the DCF, which comes in lower, 112 versus our intrinsic price, this is derived on what we've used as a 7% growth rate moving forwards, in line with analyst expectations. Baked in though is just under 10%, so maybe you look at this straight away and it will give you an answer as to whether you see the company as over or undervalued. Also, margin of safety, something we love to use, 10% at a bare minimum. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Already, this is telling us a 2% margin of safety is baked in. At 10%, a buy at 132, at 20, a buy at 117, and at 25, $110. Wall Street, even with their hold rating, nice 4% yield, see $160 into next year, 11% upside. But give us your thoughts. Do you agree with members of Congress? Is this a sell? Maybe you sit with the analyst at a hold, or maybe you believe one to buy. Before we move on to the next stock, just to let you know that we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up. We send these spreadsheets every single month, so do not miss out. The next stock, one that they've actually been selling for quite some time now, is in fact Visa, which has had this stablecoin thread overhanging for quite some time. But actually, in their latest earnings, as they typically do perform, it was very consistent, in line with analyst expectations. And if we look at their performance over the last year, up 19%, year to date up 8%, so actually lagging the S&P in 2025, but over the last 10 years they have outperformed. They're also on a pullback from 52-week and all-time highs, trading around the mid to upper end, but we see not just a buy from Seeking Alpha and Wall Street, but Wall Street 4.39, very bullish, near 4.5 to flip it into a strong buy rating. And actually on both accounts, their forward P and the current yield not too dissimilar from the 5-year average, so we would call this potentially a reasonable signal. One that also shows itself when we look at the blue tunnel. Great to see increasing over time, but right now it is sitting around the midpoint. In fact, in the last year, you couldn't have got this in an undervalued space. Over the last 5 years, though, this is a different tune. You could have got this in 2022 and 2023, as well as 2024. So it does give opportunities, which is why we say make sure notification bell is on. And in terms of growth, as we highlighted, very consistent company, grew 11% last year, expected the same this year, which on both accounts is pretty much the same as their own 5-year average. Clearly, quality company, it is growing faster than the sector. Earnings per share, a fairly similar tune, 13% in the next 3 to 5, above the sector 11, but actually below their historical of 16, where we see nearly double-digit growth expected over the next 4 quarters, 100% track record, and that forward P expected to climb a little bit lower to 26 next year. Now, institutions with their 82% ownership selling $41 billion, they've bought around 50% more in this time frame, buying twice as much in Q2. And if you wanted the reverse of the trend, well, Q2 2024 is where we would have seen this. And our intrinsic value at $350, derived solely from the DCF, is using a growth rate of 12%. As always, we have the free cash flow year on year, average a little bit higher, and we notice a low, medium, and high. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Visa or any others. But this also flags reverse DCF 11.6%, Remember, we use the growth rate and the discount rate to give us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and this indicates around a measly 3% upside. Now, if you believe this is too optimistic, at 10%, 303, indicating downside of 11, and if you're a lot more optimistic, well, at 14%, 402, 19% upside. As typical, we use the middle rate, which will give you a margin of safety, not the largest today at 3%, but this is what we would call a high quality company, and one you could argue is just a dollar cost average. Now, if you wanted to see this at a 10%, we'll buy at 314, at 20%, buy at 280, and at 25 around the $262 mark, with Wall Street themselves seeing this bang on 400 into next year, 18% upside. Now, given they see this at $400, which is pretty much around a 14% growth rate, so this is where Wall Street see this company growing for the foreseeable future, which, if you believe them, does give rise to a 16% MOS. Give us your thoughts though on stock number 2. The next stock they continue to sell is Apple, which actually had a very strong rally not that long ago. They even had their sales increase, a little bit more surprising than what analysts were expecting. We can see most recent quarter revenue up 10%, iPhone sales were up 13% year on year, and we can also note that in fact they are now due to release a new set of phones, iPhone 17, including the iPhone Air, so it'll be interesting to see whether or not that pays off. But the question always surrounding this company is growth. Are we going to see consumers get excited for what is practically the same phone every single year with just some very minor adjustments? Now, in terms of share price, up 5% in the last year. Year to date, they're actually down, one of the few in the Mag 7, negative 7%. And no surprises, even year to date, not performing well. They've been outperforming the S&P. On a pullback from 52-week high, only one buy rating and very weak at that from Wall Street at 3.95, where we get a double potential overvaluation signal, trading on a forward P above 30, historically just below 28. Yield also slightly lower, although it is a pretty trivial one at that. And even though we do get a reasonable signal here, it is pretty much right there at the upper end, so not one we would say showing any signs for undervaluation. Liberation Day, you would have been able to grab that at that point. Although this is one, as we can see, does typically trade at a bit of a premium, and that's reflected very consistently when we do zoom out to the last 5 years. No surprises then, given their lackluster growth, they get a D. We're talking 6% last year, expected barely in line with inflation. Sector is higher, not only that, so is their own 5-year average, so pretty underwhelming, at least for shareholders in the more recent period. Earnings per share, whilst it gets a D+, 10% is much lower than the sector at 15 and marginally below their historical 11.1. And yes, they do get green across the board, but actually the growth isn't that much, especially for a company that is trading at a forward P in the 30 region. And even with growth expected to the EPS next year, it's still sitting around the 29-30 mark. But institutions, unlike members of Congress, continue to buy with their 68% ownership, selling $162 billion, buying around twice as much, buying a lot more in Q2, so they are very bullish, although this is a trend we can consistently see. Q1 we get the reversal, but more often than not, institutions are in fact net buyers, and our intrinsic value gets to $200. Now, we have used the lower growth rate at 8%. Really, we do not see them growing, at least in the foreseeable future, at a rate above that, which does give rise to quite large downside at 15%. Baked in is 10.1, but would be interested to hear your thoughts whether or not in fact you do agree or disagree. What this ultimately means, if you're buying the company today, we see this trading at a 17% premium. Wall Street themselves, with their weak buy rating, see $240 into next year, upside of 3%. And if you do want to see this at the middle rate of 10%, then you are still paying a premium, not massively. In fact, you could argue that is at a fair price if you do agree on those assumptions. The next stock they've been selling is Qualcomm. Not the best most recent quarter. We do in fact notice the growth was just not there specific to their phone income stream. And if we look at their performance, they're down 2% in the last year. Year to date, up 5%, underperforming the S&P. Over the last 10 though, they've actually managed to outperform whilst trading in the mid to upper end of the 52-week range. And granted, we get a double buy rating, but both of them what we would classify as fairly weak. Now, the forward PE does sit just below 14, which isn't massively dissimilar from their 5-year average. The same to be said about the yield, so it does draw similarities from what we've seen from other companies. And if we do take a look at the blue tunnel, it is in fact sitting right there towards the lower end, so near an undervaluation signal, of which if we zoom out to the last 5 years, you can actually note in 2022, this one intrinsically was worth a lot more, and it hasn't really regained that level as of now. Something just to consider, but at least from the bottom end in 2023, it has slowly started to recover. And another poor company with the growth grade at a D-, 16% last year, pretty decent. Bear in mind, cyclical industry, we would expect numbers to have some volatility. 7.5% expected this year, which is pretty much in line with the sector, but lower than their 5-year average. Earnings per share ultimately is what lets this company down. 6% projected, well below both sector and their 5-year at 15. And even with 3 of the next 4 quarters shown to be growth, they are very low levels. And whilst they have again a 100% track record, the main thing here is the growth consideration. Forward P estimated to barely drop to around 13.4, but institutions clearly are loading up. 74% ownership, 15 billion selling, twice as much buying, lot more buying, more than 4 times in Q2, and actually one that quite consistently institutions buy a lot more than they do in fact sell. And our intrinsic value 195, the average of the 4, which as always you can grab a copy by clicking on the pinned comment below, gives rise to a 17% margin of safety. Will just make you aware that based on a DCF, it does come slightly higher at 211, and we've used our lower growth rate of 4% with only 0.4% baked in as of today. Now 17% margin of safety will just flag at 25, a buy at 147. Wall Street themselves with a weak buy rating, giving this $182 into next year, 12% upside. But let us know your overall thoughts on Qualcomm, whether you see it as a buy like institutions or a sell like members of Congress. The next one they've been selling is Johnson & Johnson, which up 8% in the last year. Very strong year to date, up 23%, outperforming the S&P and the QQQ. Over the last 10 years though, underperformance up only 91, trading very, very near to 52-week high, with another, again weak but double buy rating from Seeking Alpha and Wall Street. And surprising, after the run they've had year to date on both accounts, not too dissimilar from the 5-year, indicating a reasonable signal. And that's also reflected on the blue tunnel, pretty much sitting in the middle. In fact, over the last year, trading within the blue tunnel region. And that's something that we would say over the last 5 years, it is a fairly consistent company. And growth at NF, it does look like members of Congress are dumping a lot of stocks that have very minimal growth. In fact, for this company, year on year and this year expected in line with inflation, that is quite some way below the sector median, but not too dissimilar from their own 5-year average. What lets them down though is the earnings per share 9% when the sector does sit a little bit higher, but you could argue their 5-year average has been much lower, so it could be a win if they can hit those analyst predictions. And they're projecting 3 of the next 4 quarters to be growth. A very consistent company, beat after beat after beat. Projected forward PE just below 16 in 2026. And institutional ownership with 70% selling 20 billion, buying nearly twice as much, have bought more than twice as much in fact in Q2. And again, another one that they do consistently, more often than not, are net buyers every single quarter. And our intrinsic value, $174. Again, we'll flag DCF does come in slightly higher, where we've used a growth rate of 5%. Reverse DCF coming in at 4.4 does give rise to a very marginal premium of 2%. So in fact, you could argue trading near enough at its fair price. 10% MOS would be a buy at 157, at 20% 139, and at 25 around the $131 mark. Wall Street themselves with their weak buy rating pretty much seeing minimal movement into next year, just 1% upside, but do give us your views. We then move on to a company that can't seem to get a break even after posting positive earnings, and that is in fact Salesforce, where the CEO has said the goal is to return to double-digit growth. Question is, do investors believe he can execute on this? Now, over the last year, they're down 4%, year to date down 27%, losing more than a quarter of their market cap. But over the last 10, they've still managed to outperform, trading near 52-week lows with a double buy Seeking Alpha and Wall Street, makes a change. Wall Street very strong, 4.4 near the 4.5, and a double severe undervaluation signal, forward P20 versus their 5-year average of 30.3, of which is also confirmed when we take a look at the blue tunnel. We do note that disparity. Just one thing we do typically remind you about Salesforce: intrinsically the price has come down in the last year, something that when we zoom out to the last 5 years, it did peak around the beginning of 2024, but more often than not, company is mispriced by the market, so not something we're particularly surprised about. And growth at a C, fairly consistent, 8% revenue last year, there or thereabouts this year, only marginally higher than the sector, but actually makes sense why their valuation is lower than their 5-year. They're growing revenue at a much slower rate. In terms of earnings per share, 17% projected, above the sector at 15, little bit below the 5-year of 20, and fairly healthy earnings projections over the next 4 quarters, at least in the double-digit or high single-digit region, with 75% track record. Nice to see last 3 were beats, trading on January 2027, forward P 19.1, and institutions with their 80% ownership selling 29 billion, buying more again, 43 billion, pretty common theme we've seen today, and buying more in quarter 2, around 50%. More often than not, we see that Q3 2023 reversal of the trend. And our intrinsic price of $370 is derived using the lower growth rate of 8% to be more conservative. In fact, baked in is only 2.1% growth year on year. Maybe that gives it away that you see this severely undervalued, or you believe this is one that is going to get really hurt by its competitors. For example, if we use the up rate of 12, we're talking 489. That is pretty much a double from the current value. So using 8% in terms of a margin of safety, very high, 34%. Wall Street seeing 50% upside into next year, $365. But give me your thoughts. This is one that really does put investors on either side of the fence. They either love the opportunity or believe this one is going to die a very slow and painful death. And then we move on to AbbVie, which is up 13% in the last year. Year to date, up 23%. Over the last 10, silently outperforming the S&P. Now sitting very near to all-time highs. Double buy from Seeking Alpha and Wall Street, where we actually get a double potential overvaluation signal with the forward P above the 5-year, yield of 3 versus historical 3.9, and that's also translated on the blue tunnel, but good to see intrinsically it has been increasing. Over the last 12 months though, this one has been trading at a premium, something we notice more often than not in the last 5 years from around 2022 or the back end, and you could have got this 2020, 2021 as well at an undervalued price. And again, there's that poor rating on the growth at a D, 6 to 7% year on year, and this year around a similar level of the sector, but historically they have grown a little bit faster. Earnings per share though looking very strong, 15% moving forwards, well above the sector at 10 and significantly higher than the 5% of their 5-year average. And not only green right across the board, they're projecting some very strong growth, 100% track record. Actually, given the earnings per share growth, forward P expected to drop dramatically from 18 to 15, and clearly one that institutions like with 70% ownership, selling 21 billion, buying twice as much, buying around 3 times as much in Q2. And if you wanted the reversal of the trend to see when they've sold more than they have bought, Q3 2022, definitely one they really do like indeed. And our intrinsic value, $226, not too dissimilar from the DCF, where in fact we've used a growth rate of 7%. Baked in is there or thereabouts at 6.5, giving rise overall to a 3 to 4% margin of safety. If you want 10%, well, a buy at 203. At 20%, we are in fact talking 181, and at 25, 170. Wall Street themselves, they do have a good buy rating, fairly respectable. See this at 230 into next year, 6% upside. Maybe this is one to consider as a hold, maybe a buy, or in fact, you like members of Congress, see this as one to avoid. Do let us know. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.